many of us are very painfully aware of the declines in the housing markets over the past several years, a period of strength from 2002 to 2006, and some pretty serious bumps in the road. In this morning's U.S. Bank Economic 360, U.S. Bank investment analyst Jim Russell joins us to talk about where we are and where we may be headed. Good to have you with us, Jim.
Good morning, sir.
All right, things were real strong and then bottom pretty much fell out.
The real estate market is very much like any other capital market out there, Brian. Prices reached unsustainable levels. We also combined in 2006 with a little bit of weakness in the job market. So that's a tough combination for home prices. It's analogous to tech stocks, gold stocks, and a few other things that have come and gone a little bit. Prices simply reached unsustainable levels.
Well, how much did they drop off then?
Well, we've got a graphic that maybe illustrates that. Cincinnati has done better than most markets nationally. What you'll see here is that on a national basis that home prices are off about 34% from the peak. Now,
that's the red line is the national.
That is correct. And Cincinnati off much less than that, as you can tell. So, but just to be fair, Cincinnati went up less, down less, so it does add to a degree of stability over time.
All right, so some cities are seeing some signs of recovery right now. What are the key factors going into this picture?
It's a great question, and so basically it boils down to supply and demand. A couple of data points, if you don't mind. First of all, on a national basis, inventory is at 6.2 months of sales. Now, that's very much in line with the long-term average of 6 months of sales, of inventory that is usually on the market. So the market is adjusting over time on a national basis. Just as a basis of comparison, in the year 2008, which was one of the crisis years that you'd mentioned, inventory was at 11.1 months, so we're headed in the right direction. Secondly, I would point to the fact that new home sales are up 16% year over year, so there are signs of life. And to your question, that what determines that sort of thing, local job growth is essential in order to really provide a safety net for any local housing market. Now, Washington, D.C., Seattle, Houston, Texas are some of the communities where home prices are stable and are on the rise. We are seeing clear signs in the Cincinnati market that that activity levels are on the rise.
You mentioned that before the dip that prices were really artificially inflated. Aren't we really approaching a more realistic home value after this correction, if you will?
I think that we are, Brian, and that is home affordability is now at decade-long highs, meaning that the combination of very low interest rates, lower home prices you had mentioned, a little bit of employment growth locally, I think is a strong combination to, again, provide a safety net, perhaps add a little bit of lift. Our sources tell us that the real estate brokers for residential real estate in the tri-state area are very busy, and the transactions are indeed occurring.
And given the fact that we all need a place to live, it seems that real estate, at least a home, is still a pretty good investment.
We think the time is now. If you are a first-time home buyer or looking to buy a home, the values are on sale, interest rates are very low. We think there's some very good values out there, as you pointed out.
All right, Jim Russell, we appreciate you and U.S. Bank.
Thank you, sir.
Thank you.